Networking is huge in this world because it's more of a team sport than the single family route. And I wasn't used to that. I was very uncomfortable with it at first. I like to sit in the corner in the room and had to get out of that shell and get to know everybody, because you're not just looking at the deal. You're not just vetting the property and the potential numbers here. You're vetting those sponsors. You want to know that they're going to take it as serious as you do, because you're bringing your friends and your family's money into this, right? So it's serious stuff. So there's doing the due diligence on the property, the market, all that kind of stuff, but also on the sponsors themselves.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zonda Investments, Tim Little. And on today's show, we have with us Maria Zondervan. Maria is the CEO of Blue Vikings Capital, a real estate investment firm, and founder of Valhalla Villas, a nonprofit organization dedicated to providing housing and independent living services for autistic adults. She is the perfect example of how someone can continue doing the job they love while building wealth in real estate, and I can't wait to get into that. Maria, welcome to the show.
Thank you so much for having me, Tim.
Yeah, it is great to have you. I gave everyone a little preview of your background, but please get into the details of how you got started on your journey and how you got to where you are today.
All right, we're going to have to travel way back in time, back to the college days, actually, because I actually bought my first real estate property while I was still a college student. I was up late at night studying, as we all did, and they used to run those dang infomercials, right? And I'd have the TV just running in the background while I'm studying, and there was this infomercial from Carlton Sheets. Some of the old timers on your show might know him. And he's talking all about buying real estate with no money down. And I'm like, oh, can you really do that? That can't be possible. But as a broke college student, no money down is exactly how much I had. So I decided to take my book funds for that semester and instead buy the course instead of the books. And yeah, the rest is kind of history. I got into real estate investing, but I just did it on the side. My main passion was for wildlife, so I became a wildlife biologist, and that's what I did full time. But I invested on the side in real estate, and that's how it all got started.
Yeah, so let's dig into the details a little bit more. What type of deals were you doing at first? Was this just buying single family homes and then holding it long term, fix and flip? What kind of deals were you doing, and what did that first deal look like for you?
Yeah, the first deal was a lease option, which at the time was the newest, latest, greatest thing. Most people had not heard of it. So when you approached owners of property with that concept, a lot of them had no idea what you're talking about. So it took some educating. But yeah, that was the first one. Got in on the lease option. But tried our hands at a bunch of different things. I say our hands because my husband got involved with this too when we started doing some flipping. Found out we sucked at that. Sorry if I can say that word on your podcast. But yeah, it just took a lot longer than we anticipated. It always cost more than we anticipated. And I just didn't have the eye for it. So although we made a little bit of money on it, didn't want to pursue that. So we primarily did buy and hold. But we also read the tea leaves, right? Read the markets. So this all started way back when. So we went through the whole 2008, 9, 10 downward turn of that market. But my husband at the time was doing mortgage brokerage. So he could see what was going on. You won't believe the kinds of loans they're having us do right now. Like, this is insane. As a matter of fact, he quit the business because of it, because this just isn't right. And so we were holding quite a bit of property at that time, and the prices had gone really high. So we decided to go ahead and cash out on some of that, which was smart because that's the bubble really burst and a lot of people got in trouble there. But we did also take advantage of some of the loans they were offering then. So we got into some properties with no money down from the actual banks. They would give you 75% loan as your first mortgage and a 25% loan plus closing costs on the second mortgage on the same property. So it was just insane. But luckily we were in great markets where the rents held up. And so those properties did fine. And once we cashed out, we took that money and put it into buying a business. So we got a franchise rights for Massage Envy, which is now it's a large franchise. At the time, they were just getting off the ground. It was a new thing where you have membership-based services for massage, and that took off. That was downtown Orlando. We still have that location today. Cash flow is great. So we used the real estate to get into that. We had the money for the down payment. And then when you go get a business loan, they want of course. What's every bank want? They want leverage. And so real estate is great for that. So the real estate we're still holding became the leverage for those business loans. That's how that went. And now that cash flows, and now that cash flow goes back into buying more real estate. So it's a great little cycle going back and forth. And we've since bought another location there. And so my husband now runs the massage envy side of things, and I run the real estate side of things.
Awesome. Yeah. So again, a lot of history there, but it sounds like you had a unique experience and position. One, having your husband there as an inside man, and then you on the outside with real estate yourself. It sounds like you dodged a bullet that many people did not during the great financial crisis. And how you heard your husband talking about like how some of these loans were ridiculous, and people were getting loans that they certainly didn't deserve at the time for much more than they could afford. And I guess were those the big signs for you that you should probably cash out while you were on top? Because not many people are very good at reading the market, right? They because everyone gets caught up in the hype, and that's why it keeps going until it doesn't.
Exactly.
Talk to me a little bit more about that, and how much of your, say, portfolio did you wind up selling? Was it 50% of what you had,
It was about
or what?
50%, yes. And it wasn't massive at the time, but it was in good neighborhoods.
Sure.
We only bought properties in good neighborhoods. So back before all that mess, you could buy a house pretty much at market prices and rent it in cash flow. It wasn't as hard
Mm-hmm.
as it is today. But of course, we always worked hard to get deals that did even better than that. So we had a good margin in there. So we knew if rents went down a little bit, we'd be okay. But when a lot of people lose their homes, unfortunately, you have more demand for rentals. So the rents really didn't decrease. And so we were okay from that. I think the people that got in a lot of trouble were the ones that were buying with the anticipation of selling at a higher price. Right. So they were buying and flipping them basically, sometimes not without doing any work or doing very minor work. And some of them had a lot of deals going all at once. We were already into the buy and hold strategy. We weren't flipping. So we were in a safer position as it was, which is why we did decide to keep some. We knew we didn't know, but we suspected the value might go down. But as long as it was cash flowing, that was okay. And of course, those values have regained many times since. And we still have some of those properties because we really do believe in buying and holding for a long term. You can, of course, refinance, get money back out if you need to, but we really like having that steady cash flow coming in and the tremendous tax write offs, right?
Yeah, and I think that's an important point that you bring up. We talk about the great financial crisis and how we sometimes assume that everybody lost value, right? That if you were invested in real estate at all, whether it was single family, multifamily, a lot of people make broad generalizations that things just went bad. And that's not necessarily the case, right? There was some markets that were more insulated than others, like you talked about how you buy. And then if you're holding it for long term, you can weather that storm for a couple of years until things rebound, the appreciation, which is where you said a lot of people got caught up because they were almost being speculative in how they were buying, right?
That's
Like
right.
a stock that they thought was about to jump up, so they just buy more and more houses. Whereas those folks who were buying and holding, rents don't really drop that much. If anything, like you said, they have the potential to go up when more people are renting. Now, the value of that property may go down, and if you're over leveraged, you could get in a bad place. But if you did it somewhat conservative and you were holding for the long term and you had that long term debt, you were probably okay because you were able to hold on to it long enough to get through that storm and still sell it at a much higher price down the road once you got past all the ugliness of the financial crisis. So I think those are really important points because, again, we make sweeping generalizations sometimes about how everything was terrible, especially in real estate. And I think that's true for multifamily too, right? Commercial multifamily apartments. People weren't People who owned apartment buildings weren't suffering nearly as much as those who were being speculative at the single family level
Right.
for a variety of reasons.
They're valued
So,
completely different, right? So that had a lot to do with that. Because, like you said, the rent kept coming and they actually increased in many places. I think a lot of it was also when you bought. Like, we didn't buy anything at the top of that bubble. We bought it before
mhm.
then and we're holding. So the loans we had were also not those crazy loans, because some people that bought at the top, even if they were cash flowing or able to make their payments, the loans were calling, the banks were calling the loans due because the property was no longer worth what the loan was for, right? So they started calling loans, even if you were doing everything right, you're making your payments, right? We luckily didn't get caught up in that either, because we did buy low and before all of that, and we had the more stable loans. We didn't go with those crazy loan products, the ones my husband got out of business because they were wanting him to push.
No, that was smart. And so you were doing it, it sounds like a single family. Did you transition to small multifamily and then into commercial multifamily? What did that progression look like for
Yeah,
you?
I pretty much stuck in the single family home world all through while I was still employed as a wildlife biologist. So it wasn't
Mm.
until I really decided it was time to leap into real estate full time that I decided the best way to do that was to scale, and the fastest way to scale by far is multifamily, as I know you know and your listeners know. That's really where you can get a lot of units under your name rather quickly and can scale, and you have more control, right? We just talked about evaluations of single family versus multifamily. It's all income based. So you can really control that, or at least to some degree. You have more control, I should say. That basically happened for me in 2000, is when we got into our first multifamilies. And first, I bought the first apartment complex while I was still working, and then said, okay, yep, this can work. I know what I'm doing. I'm going to take the leap and do this full time. And that's when I quit my job.
Yeah, and that's interesting because it sounded like you were pretty convinced pretty quickly. What about multifamily syndication drew you in and made you want to stay there?
Yeah, so I didn't do syndication at first. I just bought property for myself,
Okay.
cashed in some of the single families, 1031 exchanged into the first
Mm.
multifamily, right? And then that one worked well, and then did another one. So moved that way. So I learned on my own properties first, because I didn't want to be practicing, so to speak, with other people's money. I really wanted to know my stuff. And it's not until you've gone through the process a couple of times and done asset management, because people think buying them's the hard part. No, it is not. It's managing those suckers. It's a lot of work, and it can be complex even when you have professional property managers in place. You have to make sure they're staying on the ball. You have to make sure you get the right property managers. I made mistakes there, but I learned with my money before I started asking other people to believe in me and invest alongside me.
Yeah, and I think that's a really important point too. Let's talk about that first commercial multifamily property that you did the 1031 exchange, and just for the listeners to help understand what a 1031 exchange is. Why don't you go ahead and explain that? I've done one as well, so I'm familiar, but just so people understand what that process is and why it might be beneficial.
Right. So rather than selling the single family homes and taking the tax hit on that, you can do what's called a 1031 exchange, where you exchange like kind properties. So this is a rental property for a rental property. Yes, one's multifamily, one's single family. Nobody cares in the tax world on that. And so basically, you're rolling over your basis into the new property. So there's not a taxable event. And you can keep doing that and scaling until you die, really. And then when your kids inherit it, or whoever inherits it, if you don't have kids, the tax basis resets. So you end up never realizing the gains or the hit of those taxes, right? So the capital gains taxes, they never come to fruition, really. So it's a way of either pushing that down the line or never realizing it. So that could be a huge savings if you think about how much of each sale that could cost you, how much money you'd have to pay, and the future value of that money. So that's what that strategy is. But you do have a timeline. Like, you have to identify the property in a certain length of time. You have to close within a certain length of time. There is stress and pressure in that. And you have to be careful not to get into a bad deal just to make that timeline.
Yeah, that's a huge point because, like anything, there's downsides, right? And so that's the potential downside that you start running against that clock and you need to find that replacement property, the one that you want to purchase. And you're like, okay, I only got a little time left. And then you feel the pressure to get a property that is not a good
That's
deal.
right.
And I would caution anyone against doing that because against doing the bad deal part, not a 1031 because I mean, let's think about the worst case scenario, right? You pay the taxes. You pay the taxes that you would have had to pay. That in the long run can be better than doing a bad deal that might wind up costing you much more money in the long run than those taxes would have. So just go into it knowing that there's a whole lot of positives, but there's those challenges associated with it too. And like you said, you could feasibly do it for forever, right? Going from single family to a bigger single family to a duplex to a triplex, and just keep scaling up as you go. So what was that property that you scaled into on that 1031 exchange?
That was a 12 unit apartment complex here in Florida. And
Okay.
it was a Class C property. So in a not great neighborhood. But
Sure.
and that came with challenges we were not accustomed to because our single family homes have been in very nice neighborhoods. So that was a stressor. I did want to go back to one point you were saying about the 1031 exchanges real quick. I didn't realize at the time, I've learned since, with multifamily, you have the cost segregation and the bonus depreciation stuff going
Mm-hmm.
on. And you can use that to write off a lot of those taxes. Had I known that at the time, I may have chosen to take the tax hit, but then write them off with that bonus depreciation. But again, I wasn't knowledgeable on that at the time. But now that's an option for folks while we still have bonus depreciation. It's going down 20% every year now. But there is the option if you want to not have to think about those taxes, take the tax hit and then write it off.
Yeah, and that is important too because a lot of times we tend to look at taxes as like a one for one thing as and I've learned some of those same lessons that I need to look at it more holistically. It's more of a tax strategy and you have these little taxable events along the way. For example, like I did a 1031 exchange from a duplex into a triplex. On the triplex, I was like, you know what? I'm gonna take the hit on this one and use the proceeds to invest in multifamily. But in that investment, we had accelerated depreciation, cost segregation, and that's able to counter just like you talked about the taxable event that I had before and wipe it out. So you have to look at it over like a strategy, not just one-time events. When talking with your CPA, I'm not a CPA, none of this is tax advice. It can make it seem a lot more manageable and not as woe is me to say, oh, I got this big tax bill. Yeah, what can you do to, counter that though? And one of those things is either passively or actively investing in commercial multifamily,
That's
and
right.
which is what we're going to get
And
into.
as a business
Uh,
owner, we love it too, because now that I'm a real estate professional under the tax guise, under the IRS eyes, right? My
mm-hmm.
husband's income, which is active income from his business, I can write off a lot of that with our passive losses, which are just paper losses on that depreciation, right? So when I was debating whether or not to leave my job, we did some math on that because we're paying a lot of taxes for the massage envies, a lot of taxes. It turned out that we would be saving enough in taxes from being able to use depreciation to offset that once I was a professional real estate person that it almost took the place of the salary I was making in my W 2. And of course, my W 2 is taxed at the very highest level too. So if you do the accounting for that, it was like, it almost doesn't make sense for me to keep this job. So
Yeah.
that went into the decision process. Still hard to give up that paycheck you're used to having come every 2 weeks and all the benefits and all that is still a hard decision. But once you start doing that, so yes, we're not tax advisors, but there are tax considerations when it comes to real estate that are really powerful, and you should look into if you're considering doing something like that.
Yeah, and you're especially right. If you're a dual income household and your spouse is, even relatively high income and gets taxed at that high level, the ability to write down those taxes is something unique to military, or sorry, professional real estate status, because otherwise you would only be able to write that depreciation down against your investments, which is nice and it's great. You can't write it down against your spouse's W 2 income until you have that professional real estate status, which is something that so many people strive for. But there are strict guidelines in place. It's not a part time thing.
No.
The IRS wants to make sure that you're actually doing real estate full time if you're going to get that nice little perk. So you talked a little bit too about not wanting to practice with other people's money. And I really respect that because it just goes to the point of what a massive responsibility it is to be in what the steward of other people's money, right? They're entrusting you with the money that they've worked so hard for, and you didn't want to take that lightly. So this was your way to learn the ropes, as it were, and really feel confident in what you were doing before you took on that awesome responsibility. And I certainly understand that. One of the ways that I did that too was becoming a passive investor first. That way I was able to understand the position of the passive investor, and how much, like, even something, and I say small, for me it was huge, like $25,000. It felt like a lot of money to be giving over to someone and just saying, please do the right thing with this. Now I see people hand over $150,000 and they're like, yeah, you got it, I trust you. And that's, sometimes I'm still surprised by that, but I understand the level of trust that goes into that. I understand the questions and the concerns that passive investors have as a result of having that role first. And it also helped me as I progressed into an active investor because I was able to ask questions and learn how deals work before jumping in one myself. And even that first deal that I jumped into, a syndication deal that I jumped into, I jumped in as a GP, but I did not raise any money on that deal. So there, you can almost think of it as an internship, whereas I may not be getting paid that much because I didn't get a big cut of the deal, but I also wasn't responsible for anyone's money but my own, and I was getting on the job training as well. So I think those are really important points and something that passive investors should be looking out for, right?
Absolutely.
how
Yeah.
how seriously does this person take the responsibility of taking my money?
It's a huge responsibility. I've got best friends from back in high school that are vested with me. I've got family members, neighbors. These are people I need to be able to look in the eye and say, yes, we did right by your money. So it's a huge responsibility. Much like you, I did the LP route first. Let's see how they do. Let's see what the process is like. Let's learn from them because it's a little less risky than going straight to GP. So I did both. I bought apartment complexes on my own, and then I did LP investments. And then I started capital raising for others as well. And that kind of happened by pure accident. As I'm analyzing deals, as I'm learning more, I'm just looking at tons and tons of deals and trying to pick the best ones. And then I'd find one and then I'd be telling a friend about it. And they're like, oh, can I get in on that deal too? And I'm like, sure, I'll hook you up with the sponsor. And before long, I found I had all these people that they didn't want to do their own due diligence. They want me to do all the due diligence and then tell them what to invest with. And I was like, maybe I should make this into a business, right? Because I'm really good at underwriting, really good at looking at numbers and vetting sponsors. And then as networking is huge in this world because it's more of a team sport than a single family route. And I wasn't used to that. I was very uncomfortable with that first. I like to sit in the corner in the room and had to get out of that shell and get to know everybody because you're not just looking at the deal. You're not just vetting the property and the potential numbers here. You're vetting those sponsors. You want to know that they're going to take it as serious as you do because you're bringing your friends and your family's money into this, right? So it's serious stuff. So there's the doing the due diligence on the property, the market, all that kind of stuff, but also on the sponsors themselves.
Yeah, and so expand on that a little bit more in terms of your role. And sometimes we on here we talk about like fund managers and fund of funds or syndicators slash sponsors. We have all kinds of names for
Yeah,
the same
general
thing.
partner.
So, what exactly is your role in the title, and what? And you talked about it a little bit. Is the value that you're bringing versus that person going directly to that sponsor slash general partner who found the deal and it will be running the deal.
Yeah. So there are people who do both, right? Like they have their own deals and they raise money for those, but in between those deals, they might raise for somebody else. And
Mm-hmm.
so the benefit of being with somebody that raises for other people's deals is they are vetting lots of deals. Like I have people come into me every week. Hey, raise money for this deal, raise money for that deal. Like I have more of that coming at me than I have time to really look at. But so I have like a quick checklist. Does it meet X, Y, and Z? If not, I immediately chuck that. And then I start digging deeper, and if they check everything, okay, here's what I'm really going to consider, and I might bring that to the top. But I'm looking at lots and lots of deals versus if you go straight to a sponsor, they've got that one deal going on right now, right? And it's really important to them that they close that on time. And so they're going to be pushing that deal pretty hard. So I guess I'm coming in with a little bit of a less biased situation because it's not my deal that's on the line to close, right? So I can look at it from a little offset situation. So I'm only going to pick the very best deals to get into. And then the next thing is my money goes in first. I invest in everything that I make available to anybody else to invest in. So when I say invest alongside me, that's exactly what I mean. I'm putting my money in the deal because I believe in this deal. And now I'll invite you to come in and do the same thing. And then you mentioned fund managers versus co-GPs is what we often call them, right? So in
Mhm.
some cases, in a deal, the lead sponsor, the lead general partner, syndicator, whatever you want to call them, they would invite me to raise money for their deal and bring me in as a co-GP. If they do, that means I am now part of the general partnership, right? I'm going to be part of the meetings of what's going on. I'm going to have the inside scoop of what's happening. And if I see them making some sort of decision that I think might not benefit my investors, I have the right to speak up there. I have a say, I have a certain ownership in that partnership. Okay, so there'll be even voting rights in there to where I can try to protect the investor. So that's helpful for people to come down that way. In other cases, you mentioned, might be a fund the funds kind of thing. You come in with a fund of money. And in this case, you're not on the general partnership generally. It comes in as a limited partner. So I'm always invested on the limited partner side anyway. I'm always going to have money on that
Mhm.
side. But in this case, the fund brings all the money to the limited partnership side. But the nice thing there is, so I'm in like an alliance with a lot of other capital raisers. There's 29 of us currently. So we can go after capital raising on some really large deals, 40, $50 million deals, sometimes more. And we can go to the lead sponsor and say, hey, you need to capital raise $20 million or whatever it is. If we bring you half of that, if we bring you $10 million, what kind of preferential returns can you give our investors? So a lot of times we can structure things much more beneficial to that investor than if they went straight to the sponsor. So maybe the sponsor's offering a 6% preferred return and a 60-40 split on the equity, for example. We could say,
Mhm.
hey, if we take care of half the capital raising for you, maybe all the capital raising for you, whatever, and understand the sponsors, they're dealing with a lot of stuff when they're looking at that closing line, right? Capital raising is just one aspect of it. They're doing all the due diligence, they're handling the loans, they're getting everything lined up. There's so much for them to do. The relief of not having to do all that capital raising, that has a cost. There's value to that for them. So they might say,
Mhm.
okay, instead of the 6% pref, we'll give you 8% pref to your investors. All right. That's going to make my capital raising easier. It's going to make it more likely that I'm going to be able to bring in that 10 million with the other group. And maybe instead of that 60-40 split, we get a 70-30. And perhaps there's a hurdle at 15% where the investors, after they reach 15% returns, there's a 50-50 split. Maybe that doesn't apply to my investors, right? So we can negotiate much better terms because we're coming in with a large check.
Yeah, no, and obviously it makes sense. You're saving them a lot of time and work by bringing that money to the table.
Mhm.
How, and just based on your experience, do your terms, because you're talking about a bigger chunk than I'm used to hearing, right? A lot of times we'll hear funds coming in with $1 million, $2 million. But if you're talking about the capability to raise like 20 plus millions of dollars, then you're competing with family offices, private equity firms. How do your terms compare with those different entities?
Yeah. So I actually have a good friend of mine who's in this business who just got screwed by a family office. I hate to say that, but we hear this
Mm-hmm.
happening a lot where they're coming in as a preferred equity partner or something. They're bringing a really big chunk of money. So yes, they can negotiate good terms for themselves as well, but they have been known to pull out last minute and pull that check, and
Mm-hmm.
then your whole deal goes in the toilet, right? You were expecting a $10 million check and it doesn't show up because they waited till 3 days before close to read the paperwork, and there's something in there they didn't like, some term they didn't like, maybe some preference to the bank loan or whatever the case may be. So there's a lot of, I think some sponsors are afraid to bring them in sometimes because that's happens quite frequently. So I think for someone, if they're used to working with that office and they've done it before, it's probably fine, but sometimes it can be a little scary. And when we're doing a fund like this, it's still a lot of individual investments, right? And they've already placed their money with us. We're not going to pull out last minute and pull all those funds back and refund all those people their money. That would just be a nightmare. I think it's a safer bet for the sponsor side.
Yeah, and so from what I'm hearing is basically that level of commitment. If you do that handshake deal, that agreement that you will raise this much money for a deal, you're going to do it. Compared to those family offices, which unfortunately, like you said, happens not infrequently, they tend to pull out the last minute for a variety of reasons, the strict guidelines that they have set, which I don't know, maybe sometimes they don't discover till the last minute, or just something about the deal, like you said, that spooks them. And then all of a sudden, you're out this huge chunk of capital that you needed, in some cases, to even close, which can be a terrible situation
Yes.
to be in.
Yep.
I've seen it where they pulled out where the sponsor still had enough to close, but then you still have to continue to raise money after that in order to do the renovations and everything else that you wanted to do on the deal. So it can really throw a wrench into a sponsor's plan.
Yep.
For sure.
Yep. And the other thing about going in with a professional capital raiser is if you want to diversify your portfolio, let's say you want to go from multifamily apartment complexes over to new development, perhaps, or into self storage, RV parks, or whatever the case may be. Now, if you're wanting to invest directly with sponsors, you have to now go find a whole different group of those sponsors, right? Because the people you were investing with before, they had their specialty. They may not do those other asset class where you do. Whereas professional capital raisers, they probably know somebody in all of those areas and they know how to underwrite all of those different things. So you're not having to learn a new game all the time. They can bring you stuff that they have vetted.
Yeah, that makes a lot of sense. And I think just the what you talked about, you vet a lot of deals, right? And so what does that do? That gives you visibility on what's happening in the market. It allows you to see things that may not be quite right compared to others that are doing the right thing. And just by pure exposure, you start to understand deals and markets at a deeper level than someone who doesn't see that many deals. All right, I think we do need to transition to the turbo round now.
All right.
I am going to ask you 3 questions that I ask every guest that I have on this show. I just ask you for some quick, honest answers. All right, question 1. What is one red flag every investor should look out for?
Right now, bridge loans. Watch out for bridge loans. It's still extremely expensive to buy rate caps, and they're coming in just really high. Those loans come in really high, and rents are not moving up fast enough like they were in the past to make up the difference. So be very cautious of bridge loans.
Yeah, I would almost say it's impossible for rents to move up as fast as rates have been moving up. There's that.
Yeah.
All right, what is a myth about this business that you would like to set straight?
That it's easy. That it's passive. It's passive only if you're a limited partner in a syndication. There's nothing passive or easy on the other side of this. It's a lot of work. It's a lot of freaking work.
Yeah, and there's nothing wrong with a lot of work as long as you expect it. And I think that's where a lot of people get tripped up. They passively invest and they think, oh, I could do this. And then they come in and it winds up being a lot more work than they expect, especially if they still have their job and everything else. And then they're expected to have certain responsibilities if they are on that general partner team, right?
Yep.
You will have to go to meetings. You will have to make decisions. You will have responsibilities. And yeah, I 100% agree. It is a lot of work. If you want to be passive, that's great. And I certainly encourage that. But the only way to really do that is to be that limited partner who is passively investing. All right. Final question. What does success look like to you?
Changing lives. That's really what it's all about. One of the reasons I left the field I was so passionate about, being a wildlife biologist saving endangered species, was because I have an autistic son. And as he started getting closer to adulthood, it dawned on me and said, oh my gosh, I've been so focused on just getting him through school. I hadn't thought about that long-term projection. Will he ever be able to fully support himself? Odds are no. And so I need to not only be able to support him now while I'm alive, but beyond that. And to do that, I got to scale. And so a lot of the people that invest with me are actually parents of other special needs kids that we've gotten to know along the line. And so I'm trying to help them change lives too, set that secure future up for their children. And also the nonprofit that I started, the Valhalla Villas, where we're creating affordable housing for autistic adults that have the services they need to live secure, and their parents can know that they'll have a safe place to live even when the parents can't take care of them anymore, right? And there's services there to catch them if they fall.
Yeah, that's awesome because you're talking about setting that legacy that's going to continue to help people long after you're gone. That's beautiful. All right, Maria. Hey, this has been awesome. Please tell our listeners how they can get a hold of you and if you have anything else that you'd like to share with them.
Absolutely. So Blue Vikings with an S capital.com. So I'm a Blue Viking. I'm from Sweden originally. So our flag is blue and we have Viking blood running through our veins. So it's bluevikingscapital.com. And I do have a book out that's free for anybody who wants to get into passive investing. You can download it from that website. So feel free to take advantage of that. And if you do have a special needs child, I just wrote a guide about that future retirement planning as a special needs parent. It's everything about retirement and just future housing and all those things that you need to think about when you have a special needs child, special needs trust, all that kind of stuff. I've outlined it for you. All those resources are available through my website. My email's there, my social media handles all of that, so you can reach out to me if you can't find any of those things or if you want further information.
Awesome. We'll certainly have all that information in the show notes. Maria, I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.
Thank you so much.